Boss Blunts think tank. Today I saw a massive drop in the RRP. The reverse repurchase program is getting absolutely obliterated. The RRP is basically like a Fed discount borrowing window in which large institutions, banks, shadow banks, money market funds can trade dollars for short-term, basically 24-hour treasury bonds, if you will. Treasury bills, not bonds. And they receive back the federal funds rate plus 0.05%. Let me tell you guys why this is important, okay? This is important because just about 5 months ago, there was, hang on one second. Just about 5 months ago, there was over $2 billion in liquidity on the reverse repo program. 2.55 trillion, as a matter of fact, not billion. $2.55 trillion. That's 2,500 billions, which is a ridiculous amount of money when you really think about it. And what was once $2.5 trillion less than 6 months ago is collapsed today to only $1.1 trillion. It's currently down well over 65% from its all-time highs. And this is the highest that the RRP ever was in history by a long shot. In 2008, the RRP was in the hundreds of billions, but nowhere close to a trillion. Today, you're looking at it, 1.1 trillion, and that is liquidity for these banks and shadow banks, money market funds, and so on. But it has been quickly depleted, mainly because of the increasing of rates by the Federal Reserve. The increasing of rates is causing a massive credit crunch around the world. And here in the United States, the RRP is just one of several different discount borrowing windows. There's also the BTFP, which stands for the Bank Term Funding Program. And both of them have been dwindling at pretty high rates. What this means is that in the next 10 weeks, the RRP may be completely depleted, if we even get that far. It might happen sooner if a black swan were to occur. A black swan is a term for an unexpected or unforeseen market event in financial markets. This has massive implications on the global economy, on us as individuals, both here in the United States, in Europe, North America, and abroad. Let me adjust this real quick. That being said, it's very possible that we see a market crash or a collapse for a variety of reasons. The S&P 500 is basically now being held up by 7 stocks. The 7 largest market cap stocks, tech stocks, in the world are up over 50% in 2023. Meanwhile, the rest of the S&P, the other 493 stocks, are up a measly 4%, which isn't even sufficient to keep up with inflation. If you've ever seen the movie Margin Call, you would have a pretty good idea of the possibilities of what's currently occurring. Because when market crashes occur, fire sales of assets occur. When banks crash and the government has to intervene, market crashes occur. This is something the likes of which we have never seen in history. We've seen it before, I should say, in 2008, in 2000, and in 1987, and in the 30s. But the bubble of assets and asset classes in equities markets that we're currently seeing is unfathomable. Unfathomable to the majority of people. We're currently seeing over $190 trillion in derivatives notional values across banks. $190 trillion. And these banks only have a few $1 trillion in actual assets. Those assets are rehypothecated, which means they're lent and borrowed from one bank to the next in order for them to maintain margin and liquidity. And if you haven't heard, there are currently banks in China right now that are undergoing financial runs. And this is important both in China, Asia, the North America, Europe, and everywhere around the world. Because your banks, the world, all of the world's largest banks, hold mortgage-backed securities and commercial mortgage-backed securities, as well as commercial paper, that means banknotes, in China and around the world. They currently have a cash wall in China. That means they are stacking loads of cash like bricks, like a brick wall, at these banks to try to calm investors and try to assuage their concerns. And it's not working. People are pounding down the doors to these banks, standing in queue for hours to take their funds out of the banks. If you think that this doesn't affect you because you live in the United States or Europe or South America, you couldn't be more wrong. You could not be more wrong. I understand that macroeconomics and geopolitical issues are hard to understand, and putting together the pieces like a puzzle can also be extremely difficult. But the fact of the matter is, it's less of a puzzle and more of a domino effect, in which all of the banks, all of the mortgage-backed securities, the credit default swaps, the tranches that exist within those mortgage-backed securities are lined up in rows of dominoes. And as SVB, Silvergate Bank, Silicon Valley Bank, PacWest, Credit Suisse, and others begin to fall, it causes a domino effect. Even if some of those dominoes are held in place by government bailouts, it doesn't prevent other dominoes linked together in various rows from colliding with ones that have already been propped up, and they can still fall. That's similar to what's going on right now with Metro Bank. Metro Bank needed to raise $600 million, and they failed. They raised around $380 million, but it was just enough to keep them from collapsing. This was just last week. And now you're seeing banks in China that are also collapsing. And you have the CCP, much like the Federal Reserve and the central bank here in the United States and Europe, trying to convince you that the financial system is stable and resilient. When, as a matter of fact, it's a house of cards. The reverse repo program collapsing from $2.55 trillion to $1.1 trillion in less than 6 months is exactly what I told you would happen less than a year ago when we started seeing those all-time highs. We have to see a collapse in the RRP and the other bank term funding programs and discount windows to be able to see the economic issues and challenges that are occurring in the financial sector. These are all precursors, along with yield curve inversions and disinversions, to a financial collapse, along with the Federal Reserve raising interest rates, reaching a peak, and then reducing interest rates. These are all precursors to a financial crisis. You guys in the comments bring up a great point. Janet Yellen just got done saying today that the United States can fund multiple wars, that we can afford to fund wars in Ukraine, we can afford to fund wars in Israel and Gaza, Palestine, Taiwan, and abroad. Janet Yellen isn't stupid. She's a lying fucking bitch. And they know that the majority of people are fairly stupid. I'm not talking to you particularly, because you're smart enough to be watching these channels and looking out for quality information from people that understand these sorts of situations. But think about the intelligence level of the average American, as George Carlin once said, and then realize that 50% of people are even dumber than that. How many people do you still know that are getting C-19 boosters? How many people do you think are still buying real estate? How many people do you think feel safe and comfortable in their bank because they think it's too big to fail? How many people are still bullish on the stock market and believe that everything is going to be A-OK because the Federal Reserve is pushing for a soft landing? We have some major issues in the financial sector all around the world. And the financial runs that are currently occurring in China, that we saw happening here in the United States just a few months ago, are not over. Much like the meme stock situation that we saw in January of 2021 and June of 2021, those were simply precursors to grand problems within the financial sector. Shadow banks and over-leveraged hedge funds abusing their power and abilities to manipulate markets for short-term financial gain without concern for the long-term repercussions. They're not concerned because they suspect that the Fed will be there to bail them out after a crash situation. But look out for Bear Stearns and Lehman Brothers, because they no longer exist. They got swallowed up for pennies on the dollar by banks like JP Morgan and others. And if you think JP Morgan is safe just because they're so large, well, just keep in mind that it could take up to 2 years to receive your money from the FDIC should it collapse or other banks collapse. 2 years without access to capital if you're invested in those banks is a high likelihood and probability, in my opinion. Sure, you'll get your money back. How long can you live without those funds? Without emergency cash on hand? Without precious metals? How long can you survive on the cash that you've got available right now at home? Dana brings up a great point. She says that most people wouldn't last very long, and that's exactly what they're banking on. The majority of people would not be able to sustain themselves for more than even several days without a trip to the grocery store, without cash to pay their bills, or keep the water and the heat and the electricity running, to pay their rent or mortgages. And by the time they receive their rebate from the FDIC to get their money back, what would raging inflation do to the remainder of those funds after 6 months, 12 months, or even 23 to 24 months? Because it could literally take 2 years to receive your money from the FDIC should your financial institution collapse. This is why we call out for retail investors and the average 99% of people in the world to look at your bank's investments and see if they're an ISDA bank. See if they're trading in these financial markets with these highly dangerous derivatives. This is the kind of thing that goes very slowly. A collapse of financial markets is sort of like a roller coaster, where first you're going up the hill, getting pulled up by the chain very slowly, and you could just hear it going up, and you're feeling it, and the anticipation is building as it pulls you up higher and higher. If you have your eyes closed, you can't really tell how much further you have to go. But it's a very slow climb to the top. And all of a sudden, very quickly, the peak is reached and the bottom falls out from beneath. That's exactly what happened in 2008. It's exactly what happened during the dot-com crisis. And I suspect that we're looking at a repeat, but multiplied. Because 2008 was pretty much simply related to people that were no longer willing to pay their mortgages because they were so far underwater. But now we've got a crisis that's much larger. Automobiles are at the most expensive level ever seen. And the average automobile loan is higher than ever in history for old vehicles and new vehicles alike. The average American has more debt and credit card debt than any time in the history of the entire world. The average home is more overvalued than at any point in the history of the world. wages are not increasing sufficiently to keep up with the current levels of inflation. And all you have to do is look a little bit further than the CPI lie, or should we say CP lie, because the core inflation numbers purposely exclude energy and housing and even percentages of food in order to skew those numbers lower to make Americans think that inflation's under control, but it's not. And because of all the situations that we're currently seeing and the money printing that's currently occurring, the supply and demand for the US dollar is being destroyed. The demand is insufficient to keep up with the supply that is being printed for Ukraine, for Israel, for corporate wars around the world. And we have to pay for that as American citizens, and our children have to pay for that as citizens of the earth. The fiat is a massive Ponzi scheme. And if you know anything about a Ponzi scheme, you know that the longer it goes on, the more that one must continue to earn or print in this case in order to keep it going. That's exactly what happened with the Chinese real estate developers. It's a Ponzi scheme. And Evergrande, Country Garden, Sunac Holdings, and hundreds of other real estate developers in China cannot continue their Ponzi any longer. That is why their real estate sector is collapsing, and that will inevitably bleed into our financial sector through the exposure from your banks with rehypothecated assets to other banks that hold commercial paper and bonds in these real estate developers. Those residential mortgage-backed securities, along with the commercial real estate problems here in the United States and around the world, will further deteriorate the financial system in a way that money market funds and mutual funds will also receive massive exposure. Thanks, Counterparty Risk. We appreciate you. Thanks for the super chat. You're too kind. So this all is one giant domino effect. When people can't, another thing, in Canada right now, there is a record number of people that have negative amortization. Canada doesn't have 30-year fixed rate mortgages. They have 5-year adjustable balloon rates. And many of the people right now are paying their mortgages, and it's not even enough to pay off the interest because of the balloon mortgages. So as they're paying off their mortgage, it's not going down in balance. Neither is the interest. They're not even paying sufficient amounts of interest to keep the payment from increasing. Wow, real nice, Jagoff. Robert Swift says, I could survive 1 year. That's great. I bet that's a lot more than the majority of people could. The banks right now are one of the greatest threats to this country, right behind shadow banks and over-leveraged hedge funds. You've heard Janet Yellen say this in front of Congress, under oath, testifying that they are the greatest threat to financial stability in the world. And we've seen this firsthand. The Securities Exchange Commission came out a few months ago and even confirmed that the meme stocks have a likelihood of causing further financial runs in the future. And if you haven't heard of that, go ahead and subscribe. I'll do another live stream later today or tomorrow. And I will show you the video of the Securities Exchange Commission saying exactly that. The SEC knows that AMC and GameStop and MMAT and these other meme stocks are in for another financial run. They have just passed new regulations about naked shorting and the requirement for institutions to disclose their positions. You may not like Gary Gensler. You may not like the Securities Exchange Commission. And that's okay. But the fact of the matter is that Congress and hedge funds and market makers don't like Gary Gensler because he's fucking them over. Gary Gensler is being fought against by everyone with big money, so-called smart money. Even Congress and the United States House Services Financial Committee and the chairman of the Financial Committee, Patrick McHenry, receives millions and millions of dollars every year from companies like Virtue Financial and Citadel Securities and Susquehanna and State Street. They receive millions of dollars in campaign contributions and lobbyist money. And that's why they fight so hard against Gary Gensler and the SEC to implement actual change to benefit retail investors. I know deep down inside that patience is key. And my due diligence is not assuaged by a changing stock price that does not reflect the fundamental value of a stock. For example, AMC stock right now at a value of $9.35 a share was down about 15 cents today. Has to be one of the greatest value stocks I have ever seen in my life. When you look at the fundamentals and the fact that they're profitable, they're paying off their debts faster than expected, they're increasing their revenue streams, EBITDAs, profit margins. It's obvious that the fundamentals are fantastic in that company. And the technical analysis is great too. When you look at certain factors like the on-balance volume, when you look at factors as the fact that there are over 4 million investors that hold the stock, and the charts appear to be repeating exactly what happened in January and June of 2021. The meme stock craze is far from over. That being said, I remain steadfast as a supporter of AMC Theaters and Adam Aaron and even GameStop. even though I do believe that AMC has a much greater potential, both percentage-wise and dollar-wise, to reach a much higher valuation than GameStop ever did and ever could. Now, that's not just speculation. That is based off of the real numbers that were received by Congress during their congressional report into the AMC and GameStop situation of January 2021. We found out that Robinhood reported that they were one of 6 other brokerage firms that received a margin call from the National Securities Clearing Corporation of over $2.2 billion on the day of January 28th, 2021. They had no choice but to pull the buy button on these stocks and fucked over millions of retail investors in the process. In addition, we also found out that the value at risk to Robinhood for GameStop was $250 million value at risk. But for AMC Theaters, it was $850 value at risk. 850 compared to 250. The reason being, there were more retail investors diamond handing AMC than even in GameStop. And I know the GME elitists are going to lose their shit because I said that, but I'm neither a GME elitist nor an AMC elitist. I support both companies and both stocks. But the numbers don't lie. The fundamentals don't lie. GameStop's fundamentals are currently better than AMC's simply because they have around $1 billion in cash on hand and no debt. But AMC fundamentals are greatly improving. They are profitable. They are increasing their profit margins and their earnings per share every single day. Not to mention, they are now number 11 out of all the hundreds of distribution companies in the world for the year of 2023. And they just became a distribution company about a month ago or two, about 2 months ago. Taylor Swift pre-sale tickets just began going on sale a couple weeks ago. And she just had an opening weekend in which AMC grossed over $128 million in the opening weekend. This makes Taylor Swift's concert the new #1 top-selling opening weekend concert, beating out Michael Jackson's 1999 or 1996, I believe it was 99 concert, where he grossed around 78 million. Taylor Swift eclipsed that by over 128 million total. The fundamentals are there. Technical analysis is there. The due diligence and the information is there. From the NSCC, the OCC, the DTCC, Robinhood, the other brokerages, and AMC as well. That being said, I wish you peace and wealth. Yeah. Make sure you're properly hedged. Things are not looking good for the financial sector. And yeah, AMC, GME, MAT meme stocks, we're going to be so fucking rich. Not a financial advisor. Do your own due diligence. Have a great fucking day.